Hi guys, in today's video I want to talk to you about what is a mutual fund and investing for your age. So a mutual fund is an investment vehicle, is actually a company that holds similar investments. Consider an organization like a bakery. So a bakery may have many bakers working within the bakery. With a mutual fund, let's say a technology mutual fund will hold shares in technology companies. So let's talk about Apple, Google, and Amazon, all technology stock, and they're in a mutual fund, a technology mutual fund. The managers of this mutual fund will buy and sell you mutual fund shares as one investment, as opposed to you having to purchase shares in Apple, Google, and Amazon yourself. So previously we had the example of when there's a iPhone launch and the expectation surrounding the price going up because the phone is popular and does well in the market. Today let's consider an iPad launch. So a new iPad is coming out. There's the expectation that it will do well and therefore Apple stock will do well. You have your Apple stock at $100 in your mutual fund. Unfortunately, the iPad is launched, people don't like it, and it flops. The stock price goes down. So your stock price has gone from $100 to $75. And while if that's the only stock that you had, you'd have lost $25. You also have Google and Amazon shares within your mutual fund. Now, because they all sell tablets, with the iPad flopping, chances are those investors are pulling their money out of Apple, is putting their money into Google and Amazon because they're thinking the competitors are now going to benefit from Apple's new product not doing well. So while you may have lost $25 from the Apple stock, your Amazon and Google shares may have both gone up by $25. So now you have $300. You started with $300. You've lost 25 from Apple, but you've gained 25 from Google and 25 from Amazon. So that's 50. 50 minus 25, you've made $25. So what mutual funds do is they reduce your risk, called risk mitigation. So mutual funds mitigate the risk. So we spoke in our last video about risk versus reward. Mutual funds reduce that risk. However, in a sense, they also reduce the possibility for reward. Consider if your Apple stock had been successful, that iPad had been successful, and it moved from $100 to $125. Now your Google and Amazon stock may have stayed the same, or you may have lost some money. Let's say they stayed the same. So your Apple moved from $100 to $125, and then you have $200 in the other two. So now you're at $325, right? It's good. You have a return. That's great. However, if you had all $300 in that Apple stock, you'd have $375. So it mitigates against the risk. The mutual fund mitigates against the risk. However, it also limits your reward. But it is a good tool. I'll say it's a good tool because diversification is always a catchphrase in investments. In investments, you don't want your eggs in one basket, and a mutual fund is the way to do that. A mutual fund is one basket with eggs in multiple baskets. It's a very interesting tool, and it's actually a legal entity in itself, managed by individuals. And we are talking about 3 technology stocks here, but a mutual fund can have 10 stocks. Some have 1,000. So as your risk is spread out across many different things, say one of those companies fails altogether. Let's say over your 1,000 companies, GameStop is in there, it goes bankrupt. Let's say some of you may know about the financial crisis when Lehman Brothers went bankrupt. If you lost those two, overall you haven't lost your money, because the mutual fund, the other things in there have supported it and held it up. So there are mutual funds as well available for you right here in Barbados. I mean, our channel isn't about advertising mutual fund companies and so on, but it is about assisting you. So there are companies like Fortress, Royal Fidelity, Sagicor, and I'm sure there are some others that I'm forgetting that are there that allow you to purchase mutual funds and diversify your risk in that way. Some mutual funds will be equity mutual funds, like we've been speaking about all this time, where there are different types of stocks, shares from different companies in those funds. Locally, we'll have access to Caribbean mutual funds. So things that have shares in Caribbean companies from Trinidad right up to the Bahamas. But then there are also mutual funds that hold bonds. These are called fixed income mutual funds. So these may hold government bonds from Barbados, a company bond from Bahamas. You would have heard about, if you're Barbadian, you may have heard about Needham's Point Holding Bond, which is related to the property that the Hilton is on. So there is a bond that they use to help the upkeep of the property there. We've heard recently that they defaulted on 2 interest payments, but that is an investment that is in some mutual funds locally. But thankfully, because it's in a mutual fund and that mutual fund has other bonds in it, even though they miss bond payments, you may not have really lost any money because your eggs weren't all in one basket. And that's what a mutual fund really allows you to do. To be able to have a little piece, normally we have much less than 1%, but to have a little piece in many things. So we are owners, because we spoke about before that shares are ownerships in companies. So we are owning companies all throughout the Caribbean in very small portions. We are helping those companies, and in return, as they are successful, we make some money ourselves. So having covered mutual funds, let's talk now about investing for your age. And this is related to mutual funds and stocks and bonds, as we were discussing previously. And we'll go further into this in future videos. But basically, the younger you are, the greater risk you can take. The older you are, maybe the less risk that you want to take. So the closer you are to retirement, it would be wise that your portfolio has more bonds or fixed income mutual funds, that your portfolio has money market. We spoke about deposits and savings as you're trying to save and preserve your nest egg for your retirement years. We spoke about capital preservation a few videos ago, and as you're in retirement age or have retired already, then you're more looking towards capital preservation. When you're younger, in your 20s, you've just started working, you may still live at home, you may not, but you can take more risk on. You can invest hoping to make big returns in 5 years, 10 years, 15 years time if you're 21, or you may be able to weather a loss and recover again. So we would find that younger people would have more aggressive portfolios, we would say, which would have more stocks in them and less bonds. However, no matter what age you are, you should have a blend of these. But we'll speak more about how we should blend, what percentage should be for younger people and what percentage should be for someone older. So if you're younger, your percentage of stocks would be higher, and if you're in retirement years, then your percentage of bonds would be higher. And that's simply what it is capital preservation versus capital appreciation. And we have to be wise when we do both of these things. And the best way to go about that for many of us would be mutual funds in either scenario. So the younger people, they can have equity mutual funds, which are the mutual funds that have stocks in them. And yes, they may be aggressive because their stocks, but at the same time, they are mitigating their risk by having them in a mutual fund. The older people may have bonds still in a mutual fund. Yes, they're preserving their capital, but they're giving themselves an even greater chance of preserving that capital by, again, mitigating the risk through diversification. Diversify, diversify, diversify. So mutual funds, a good investment tool for any of us to start if we're young or we're old, but how that's made up in terms of how risky we invest would be determined by your age and just your own preferences. Next video, we'll get more into building your portfolio and we can discuss that further. Any questions or comments you have, please write them in the comments below. Thanks, guys.